In my earlier videos, I discussed how C corporations are taxed and S corporations get taxed. Today, we're going to talk about how partnerships get taxed. Now, a partnership needs a unique federal EIN number in order to conduct business. So, a partnership files Form 1065, and the filing deadline for it is March 15th. Now, a partnership issues a Schedule K1 to each of its partners, and then the K1 information is used to report on their individual 1040. Partnership also happens to be a pass-through entity, quite like an S corporation, but it does not pay any salaries or wages to its partners. Instead, like I said earlier, they can make periodic draws. All general partners, like sole proprietors, pay self-employment taxes on their share of drawings that they've made from the business. So what are the tax obligations of a partner? Rule number one, a partner is not an employee of the business, which means he does not run any salaries or wages. Instead, he can make periodic draws from the business itself, and that income gets reported on his individual Form 1040. Now, when he reports that income on his individual tax form 1040, he automatically becomes liable to pay self-employment taxes, which means he's required to attach Schedule SE in the form of self-employment taxes to his Form 1040. The other type of taxes that a partner is required to pay is estimated tax payments, which happen 4 times during the year. If the partnership loses money, in that case, it's not required to file those estimated tax payments. I shall mention estimated tax payments actually cover Social Security and Medicare taxes. Partnership accounting can be complicated. So as a piece of advice, I would say have good books in place. Reason being, each partner has an opening capital balance and a closing capital balance. Partners might make contributions in the form of assets, such as real estate, or even services like service contributions as well, or even cash contributions. So a good idea would be to have books in place so that you're able to keep track of all the money that's coming in and going out into a partnership. If there's any money left in the partnership, which means if you happen to have any retained earnings, that money is going to be taxed by Uncle Sam. Now, a good idea or a good piece of advice would be, if you wish to have retained earnings within the partnership for growth and expansion, consider incorporating your business, which means moving to a C corporation status. What happens if a partnership has losses? Quite like profits, the partnership losses also get distributed amongst its partners, and those losses can be used to offset against their other active income to reduce their taxable income and even produce a tax refund. Well, I hope you liked this video. In my next video, I'll talk about partnership liabilities and how to end a partnership.